You've heard this phrase a lot. It's been dominating the airwaves as analysts and experts and commentators and us. We leave the 2012 election in the US behind, and they've been talking now about the economic collapse, or perhaps that's putting it too extremely, but the huge economic effects if the US allows itself to go over this fiscal cliff. So with us is Deryck Janse van Rensburg, who's portfolio manager from Nedbank Private Wealth, and Nicky Weimar, who's senior economist from Nedbank, to join us for a look at what the fiscal cliff is and why everyone is talking about it. Nicky, it's one of those terms, it's a shorthand term, which everyone thinks they understand. A lot of people perhaps be hard-pressed to explain it. We know it's a bad thing and they must try and avoid it. Where does the term come from and what does it mean?
Well, it's the popular term, as you say, that's being used for the little, rather big conundrum that the US will face, or the US government will face, at the end of this year. And essentially what happens then is you've got a combination of previous tax relief that have been provided that will expire, the one being the Bush-era tax cuts, and the other being the Obama payroll tax holiday. So those two expire at the end of this year, 31 December, at midnight, 31 December this year. At the very same time, if you all recall last year, the US hit its congressional debt ceiling, and it had to renegotiate that debt ceiling. And during that, the Budget Control Act was put together, and in that Budget Control Act, they agreed that if that debt ceiling gets breached again, certain automatic spending cuts will come into effect. And that will be breached again. So by the end of this year, at the 31 December, basically these spending cuts will come into effect. The combined effect of that, of the tax increases and the spending cuts, will have a very dramatic effect on the US economy. Just to give you an example, just the Bush-era tax increases will take $280 billion out of the US economy, $1 billion. The Obama payroll tax, not that dramatic, that's $125 million taken out of the economy. But the spending cuts amount to, in 2013 alone, somewhere between $98 billion US dollars to $109 billion US dollars. It will cut the deficit by $560 billion US dollars. So for austerity wise, it's a brilliant plan. But ultimately that means if you're cutting the deficit, you're extracting stimulation out of the economy, which means you could have an effect where you're shaving between 3.5 percentage points to 4 percentage points off US GDP. They're only growing at about 2%. Means starting January 2013, the US dips into recession.
We've got a graph that actually illustrates, what the fiscal cliff is and what it looks like. And if we can pull that up on screen, because it aptly illustrates just what happens if current policy or, current policy spending minus tax cuts, that's your dotted line right at the top there. And if those spending cuts and tax increases kick in, what actually happens? And you can very clearly see why this is called the fiscal cliff. I mean, at this stage of the game, Deryck, as an investor, hearing about all of this, just how nervous is it making you that we're not going to see resolution come to the fore, that we're not going to see compromise being reached, and come midnight, December the 31st, as the fireworks go off globally to celebrate New Year, that we go off the fiscal cliff?
Yeah. And I think just looking at that chart there, it just shows you how steep this cliff actually is. But I mean, looking at it from a solution perspective, and correct me if I'm wrong here, where we're sitting at this point in time is the potential of this debt deficit increasing over the next sort of 12 to 18 months, and this debt burden that sits in America getting bigger and bigger essentially. The way to probably fix it and for the economy to amend itself is potentially to inflate your way out of it, and correct me if I'm wrong. So, how do you bring inflation to the mix when you've got spending cuts coming into play? And it just seems like America, from a developed world perspective, is in a catch-22 situation where a lot of the cash injection that's taken place to date has caused the debt deficit to increase to the levels that we see it. The way to fix it is potentially to inflate your way out of it, but now you've got a decrease in spending that could potentially weigh on the markets. So what is the solution, and how do we fix the position that we're in at the moment, and what are the potential different options that the US government has available at this point?
Well, listen, the US have been trying to monetize their debt, which is what you're referring to, inflating the debt. I think far more aggressively than any other country. I mean, we're at QE3 now. We started with QE1, which was almost $3 trillion US dollars. QE3, which was two, which was another $600 billion US dollars. Then we had Operation Twist extended, and now they've given up. They say, well, we'll print as much as we need to for as long as we need to, and that's the QE3, which is an open-ended stimulation. So, no, I think they've been doing their best to monetize the debt, and the reality, though, is that it's not that related to what's happening here. This is a separate plan and an attempt really to control what is spiraling debt levels. So this is the beginning of the austerity. So essentially, the US has to control spending. It can't let it run away because its debt is already over 100% of its GDP. So essentially, what the market would like them to do is to find some kind of compromise. So the Republicans and the Democrats have to strike some kind of compromise that will allow them to start to address the deficit and the debt problem, but in such a way that it doesn't tip the economy back into recession.
So, Nicky,
that's the problem.
Let's look at it. I often like the analogy of the Springbok rugby team. What team should they pick? What's our opinion? And what team actually will they pick in the end, whether we agree with it or not? What is going to happen? Because we've had the opening shots fired. Barack Obama has said, no, we're going to tax the wealthy. So that's
the top 2%. Yeah, he said.
And one of the Republican advisors we reported earlier said, no, maybe we need to compromise on this. So do you see there being compromise? Are we going to go to, I don't know, December the 30th when they're all on leave?
Yeah, basically when they're talking about the fiscal cliff, they're saying, all right, politicians don't agree on anything, nothing is done, and this kicks into effect. Okay, so this comes into effect.
That's the extreme case.
That's the extreme case. So that 3.5 or 4% off US GDP growth and tips them into recession is the extreme case. But obviously neither party political ends will be served by a short, sharp, and severe recession. So ultimately, there will be a form of compromise. And now, the Speaker of the House or the Speaker of the Senate, Nancy Pelosi, said that they are ready for a grand bargain. Most people expect that will probably be quite a bland bargain. That is what you'll get, that they will come to some kind of compromise to avert recession, but not enough to actually lift growth, and so that the US economy in 2013 will not look too much different from the US economy we've seen in 2011, growing really more or less at the same sort of pace. And what you're really just doing is kicking the can down the road, making the fiscal issue more of a medium-term concern than an immediate short impact. So that's probably what's going to happen. You'll have some kind of deal. It won't be perfect. It won't do anything to appease the markets. It won't address the deficit in any significant way over the medium term, but at least it will start that process, and that will be the situation.
Look, just looking at it from a broad perspective, and my own personal opinion of it is, if we look at the American economy, we obviously went through the financial crisis, and basically you had the corporate America that fell into a lot of debt and needed the bailout packages that the government provided. So I quite like the analogy that Nicky's making there in terms of kicking the can down the road. The problem is not solved. We're just handing it off for now, and I think that's really what's going on here. And the debt from corporate America has suddenly been transferred to the debt in government America. How do we solve that? We've got to look at ways to tax the wealthy, as you mentioned, David, and I think that that corporate tax is something that's going to find its way into America quite strongly over the next 18 months. And as well, you need inflation to come to the picture to fix this problem. However, this is not a quick fix. This is going to take time, and again, kicking the can down the road is a hope that these taxes are going to help to, the debt burden that sits in America, as well as inflation coming to the picture to help get out of this position. However, it's a long process, and during this time, I think that you are going to start to see moments of excitement within stock markets and moments of stagnation. So, there's no clear-cut way as to how we're going to get out of it. All it is a matter of timing and being patient.
Well, there we have it, as clear as you.
One more question I have for both of you. You can answer it quickly. Does it help that Obama is now in his second term? He doesn't have to worry about re-election. He can do things perhaps that he wasn't able to do in his first term.
Yes, it does. He's got a clear mandate, especially on taxing the rich. He ran on that. And he got elected on that with a fairly convincing margin. So he can push that envelope because he has a clear mandate to do that. But on the other hand, he does need compromise. They do all have to agree to a plan, and that has not changed. They've got slightly more leverage because A, he's got a mandate, and B, they've got a bigger majority in the Senate now.
Yeah, and I think just to add to that, you know, the re-election of President Obama kind of like sat with up in air as to where the US economy is going. Now that the free market system has clear, decisive action as to how to address the problem at hand, that's what the market likes to see. So in my personal opinion, I'm quite happy with the re-election of President Obama. I think he's halfway through his plan with all his professional advisors and all the help that he seeks to try and address the problem. And we just need to see him play out his second term to see the plan come into action. So I'm quite relieved that he's in for the second term, and let's see what transpires.